On the 8th of December 2019, the first COVID-related hospitalization case was reported in Wuhan, China. It took a month for the World Health Organization to make a public statement about the mysterious pneumonia cases. In the meantime, the S&P was ignoring the news and continued its steady rise. 3 weeks later, Chinese officials put the whole city of Wuhan with its 11 million inhabitants under quarantine. This had started a slight sell-off in the markets. A week later, on the 31st of January, the WHO issued a global health emergency, and the markets crashed. Not really. The markets continued to go up for another month, reaching all-time highs, until the 25th of February, when the American Center for Disease Control and Prevention declared that COVID-19 is heading towards a global pandemic. That was the beginning of the fastest sell-off in stock market history. Within a month, the S&P had lost 35% of its value, but the Fed was well prepared and quick to act. Within 2 weeks, they cut interest rates from 1.5% to 0. On the 15th of March, they announced their quantitative easing program, stating that they would be buying at least 500 billion in treasuries and 200 billion in mortgage-backed securities over the coming months. The announcement had little to no impact on the market, which dropped another 12% that week. At this point, $5 trillion of market value had vanished from the S&P in the blink of an eye, with no stoppage on sight. Running out of options and time, the Fed revised its previous QE statement the following week, and they said they're willing to do whatever it takes to support the markets. And so they did. Until the year end, they bought $8.1 trillion worth of treasuries and mortgage-backed securities. Additionally, the government has given out $4.5 trillion in various COVID rescue programs. While the fear of deflation made headlines throughout 2020, the markets experienced an unprecedented V-shaped recovery. Exactly 1 year after the pandemic-fueled sell-off had started and the market rallied almost 80% from the COVID lows, Michael Burry, famous for his contrarian market stance, sent his first warning that inflation is coming. 2 days later, he sent a following tweet that said, "The US government is inviting inflation with its modern monetary theory-tingled policies. Trillions more stimulus and reopening to boost demand, as employee and supply chain costs skyrocket." 4 months after his initial inflation call, while the market continued to go up with investor confidence peaking, he sent another tweet that said, "People always ask me what is going on in the markets. It's simple. The greatest speculative bubble of all time in all things, by 2 orders of magnitude. Hashtag flying pigs 360. On June 17, 2021, he gave a name to what was coming. All speculation is doing is drawing in retail before the mother of all crashes. When crypto falls from trillions or meme stocks fall from tens of billions, hashtag Main Street losses will approach the size of countries. History ain't changed." 5 months later, close to the peak of the market, when the S&P reached 4,700, Elon Musk sent a tweet calling Michael Burry a broken clock. Burry didn't respond immediately. 6 months later, after the market correction had started and Tesla shares tumbled over 35%, he gave his response. Habitually, be 1 to 2 years early on literally everything, and you too can attain a broken clock status. The following month, he sent another tweet of the major market events that he had correctly predicted in the last 20 years. His latest tweets indicate that we are far from over, saying that we have only experienced multiples compression so far.
This is an invalid validation of what America is doing.
So what makes Michael Burry believe that we're only halfway through the crisis? Recently, Burry tweeted about a CNN report that said, "Big box retailers such as Target are faced with the prospect of paying customers to keep unwanted items due to a massive surplus of product inventory." According to Burry, this highlights a supply glut and is an example of the Bullwhip effect. Casting aside the contemporary concern about soaring inflation, the famous contrarian investor argued that this time we have some major deflationary forces ahead of us. Doubling down, he suggested that in the coming months, economists will see disinflation in the consumer price index, which will then ultimately lead to the Fed to reverse its stance on rising interest rates. But how can an article about Target incentivizing its customers to hold on to unwanted products inspire such a paradigm shift in monetary policy? It turns out that Michael Burry, with his Twitter nickname Cassandra, which is a reference to a goddess in Greek mythology that predicts misfortune and disaster but never believed, knows a thing or two on what's ahead. So what is the bullwhip effect? It's a disruptive event in the inventory management system, which describes a situation in which product demand forecasts do not align with actual sales, leading to massive volatility in inventory levels with an amplified impact throughout the supply chain. The name derives from the concept in physics, where a comparatively small movement of a person cracking a whip extends out to a much bigger motion at the tail. Under a business context, if a retailer anticipates greater product demand based on immediate sales data, the company's procurement team will reach out for additional inventory to distributors. In return, the distributor will communicate the demand spike to the product manufacturer. Everybody in the supply chain benefits from the increased sales. That is, of course, if the forecasted demand is accurate. What Michael Burry figured out is that the vast majority of big box retailers have their forecasts dead wrong. The pandemic-fueled pent-up demand caused many retailers to overstock and manufacturers to produce more in preparation for a burst of orders. Excessive supply results in a surplus of inventories, forcing retailers to either slash their prices or be left with a pile of unsold goods. Either or, corporate profits are expected to shrink significantly, according to Burry. Therefore, it's only a matter of time before affected companies take action by laying off some of their workforce. Additionally, Burry has been tweeting for months about the American consumer, who are facing rising costs of food, energy, and housing, and are on track to nearly exhaust their savings by the fourth quarter of this year. He noted that with lower savings rates and increased amounts of credit card debt, we could see a consumer-led recession by Christmas, which will drag down corporate earnings even further. In other words, if people are becoming more indebted and their rainy day funds are dwindling, they're more likely to slash their spending, which will impact economic growth going forward. Inflation is squeezing consumers in a way we have not experienced in years. The purchasing power of the average household is rapidly declining, making it much harder for families to save. According to Michael Burry, the miscalculated excess inventory levels by corporations, together with shrinking savings and consumer spending, are strong enough reasons to force the Fed for a paradigm shift. He believes that towards the end of the year, these two forces combined can potentially stop the Fed from raising rates further and even start cutting again to stimulate the slowing economy. In light to this, it can be argued that inflation is transitory after all, and a dovish Fed lowering interest rates can benefit the stock market, while Burry says not so fast. Despite his case on the bullwhip effect having a strong deflationary force which will likely cool off inflation from going out of control, the inflation levels of 2% we have been used to for the past 15 years are still in the distant future for him. He recently tweeted about two main inflationary forces that are likely to remain in the short run, which he believes will create a high-level floor for inflation. Burry argues that blue-collar workers will stay hot in demand in a labor market that has remained tight despite the looming recession, while office workers could face job and salary losses. In other words, Burry predicts labor shortages to linger in sectors such as manufacturing, trucking, and hospitality. In his tweet, he shared a link to a report detailing Tesla's move to lay off 200 workers, including data analysts, and shutting down a San Mateo office dedicated to the company's semi-autonomous driving division. Tesla's latest round of layoffs occurred weeks after Elon Musk indicated his plans to slash 10% of the company's salaried workers. Elon also said that he has a super bad feeling about the state of the US economy. Burry's second persistent inflationary argument was made in his recent tweet, where he warned about the continued and potentially escalated geopolitical tensions, which might create further supply chain problems and shake up the already weakened economy. He indicated the possibility of Chinese aggression towards Taiwan in 2023, and the ongoing Russia-Ukraine war to spread further into the European Union through Lithuania. Burry shared his views alongside a Bloomberg article detailing an onshoring trend, in which US companies have increasingly shifted production stateside, as they seek to avoid disruptions that occurred during COVID-19 lockdowns. The report noted that the construction of manufacturing plants within the US has surged over 116% over the last year. In summary, Michael Burry is still extremely bearish on the market and doesn't have much of a positive outlook in the short run. His arguments have both deflationary and inflationary elements, so it's going to be extremely interesting to see which one will outweigh the other. But ultimately, all his arguments boil down to a significant decrease in corporate earnings, both from the bullwhip effect as well as the reduced consumer demand, alongside the increased wage pressure caused by blue-collar workers combined with continued geopolitical tensions. That being said, a significant central bank intervention could change everything, but the current inflationary dynamics limit the Fed's ability to stimulate the slowing economy. A slowdown in economic activity seems inevitable. The question comes down to whether inflation could slow down enough for the Fed to stop rate hikes and start cutting. And even if they could, would that re-trigger inflation to go higher again? This tweet of Burry summarizes his view pretty well. As we covered in this video, there isn't just one major force that he bases his market view on, but instead he argues that there are multiple verticals in play which are at different phases at the same time. He further elaborates that most equity investors miss the bigger picture by only focusing on one of the verticals. Bear in mind that any new information presented until the year end could technically change a lot of the assumptions made above. Let me know down in the comments if you agree with Michael Burry's views on the market and whether the Fed could start cutting again. If you made it this far, welcome to Financial Interest, where we cover interesting financial topics weekly. Feel free to check out our previous videos. Don't forget to give the video a big like if you enjoyed it, of course, and subscribe to stay tuned, and I'll see you all next week.